Union is here to talk about credit score and how to maximize it. Thank you, David.
Thank you. As mentioned, my name is David Cleveland. I'm one of the underwriters at Truity Credit Union in the Consumer Lending Department. The primary function of my job is to analyze credit bureaus when they come in attached to applications and determine if that applicant is a good risk for Truity Credit Union to take on for a new loan. My hope for this presentation is that you will leave with a solid understanding of what a credit score is and a general understanding of the components that determine your credit score, and then some ideas on how to either start building your credit and or maximize the potential credit score that you will build over time. There are a few terms that I'll be using that probably should be explained before we get started. One is potential credit score, because everyone has different credit scores determined by a number of factors. Each person has a potential highest credit score based on where they are right now in life. Someone who's been using credit for decades is going to have a much higher potential credit score than someone who is just getting started. Another term is closed-ended loan. This is a loan that has a closed end. Many auto loans, personal loans, mortgages, those are all closed-ended. You get the loan, you make payments over time, and then you make your final payment and that loan is finished. The other definition is for revolving credit, and that would be credit cards, lines of credit, anything that continues to revolve and go on. You can max out that credit card, you can pay it off, and then you have that credit available to you after you've paid it down. Your credit report is kind of like a resume. When you go to apply for a job, you want to put your best foot forward. You want your potential employer to see you as the best candidate for the best job, for the best pay. And likewise, when you're applying for credit, you want that lender to view you as the best candidate for the best interest rate and the best terms. So for that reason, it's important to make a good first impression for the person who is reviewing your credit. Now, credit scores can range from 400 on the very low side to 850 plus, depending on a number of factors. And that neighborhood of 850 is considered to be perfect credit. Now, there isn't just one credit score. There are a variety of credit scores. There are actually three major reporting agencies: Equifax, Experian, and TransUnion. All three of these bureaus utilize what's called a FICO scoring model. FICO is a widely accepted scoring model that was developed by Fair Isaacs and Company. It uses principles of higher math and complex algorithms to predict the risk that an individual borrower poses based on a number of characteristics in that specific borrower's credit history. Additionally, there are several editions of the FICO scoring model within each version, and the versions would be Equifax, TransUnion, and Experian. For instance, Truity utilizes an auto-enhanced version of TransUnion for secured consumer loans. So for your auto loans, recreational vehicles, things like that. That auto-enhanced version gives more weight towards how an individual has paid those similar types of credit loans, credit lines. And then we use a bank card version for credit cards, which of course puts more weight on how an individual has handled credit cards and revolving trade lines over their credit history. Our mortgage department pulls one version from TransUnion, one version from Equifax, and one version from Experian in a merged credit report. We also use what's called a bankruptcy indicator score, and I'm going to refer to that a couple of times throughout this presentation. This score is one that you will probably never see. It's utilized by the lenders to give us an idea of how likely an individual is to file bankruptcy in the next year or two. The point in all this is that even if you check your credit and have a perfect score on one bureau, it's very unlikely that you're going to have the same credit score for each of the 3 bureaus, and even more unlikely that you're going to have the same credit score on the different versions within those bureaus. So how this FICO formula works? Well, I can't really explain in great detail how these complex algorithms work, but we do know that there's a general formula that contains 5 categories. And these 5 main components make up your FICO score and your potential high credit score. By understanding each of these components and the weight that each of these carry in our credit score, we can take specific actions to maximize our score. These 5 categories are payment history, capacity, length of credit history, new types of credit, types of credit, and new credit. Payment history is the largest part of your credit score. It makes up 35% of your potential score. This category is also the most straightforward and easy to manage. Basically, if you pay your bills, if you pay your obligations on time each and every month, that 35% of your potential score is going to take care of itself, and you're going to get the maximum possible points for that. Capacity is a little more complicated. It's the amount owed. Capacity carries 30% of your potential credit score. This mainly focuses on the amount you owe on a debt in relation to the maximum available credit or the original loan amount. And it focuses on a percentage rather than the actual dollar amount of the debt that you carry. For instance, if someone owes $200,000 on an original $500,000 mortgage, their capacity is much better than someone who owes $140,000 on an original amount of $150,000. The role that capacity plays in your credit score differs between those close-ended loans, close-ended credit lines that I talked about, and the revolving credit lines. Every close-ended loan starts out at 100% capacity, and therefore that side of capacity does not carry as much weight as the revolving credit. There's a 30% rule, or what I call the 30% rule, where credit cards and line of credits, revolving accounts come into play. This means that you want to keep your revolving balances below 30% of the credit limit on that account. For instance, if you have a Visa with a $1,000 credit limit, you want to keep your balance below $300 rolling over from month to month in order to maximize that potential credit score as far as the capacity is involved. Now, ideally, you would pay off revolving accounts each and every month in order to completely maximize those capacity points and also minimize the amount of interest that you pay on that account. Next is length of credit history. This portion makes up 15% of your potential score. This looks at several time-related factors, including the age of your oldest account and whether or not it's still open, the average age of all of your credit accounts, and then the individual age of each account. As accounts, what we call season or age, as they get older and older, then that 15% of your potential score is going to be utilized and be maximized. The next part of the FICO score is types of credit, or it could be referred to as variety of credit. This portion makes up 10% of your potential credit score. Basically, creditors want to know that you can handle a variety of debt, not just one. For example, someone who has a mortgage, an auto loan, a credit card, and maybe a store card is going to have a higher scoring in this section than someone who only has an auto loan or someone who only utilizes credit cards or store cards. And then the final portion of the potential credit score is new credit, and this also makes up 10% of the potential score. This category includes the number of times you've applied for credit within the last year to 2 years, as well as any accounts that you've actually opened that are considered to be new. As your inquiries or applications for new credit get older, those accounts age and this category improves and maximizes. Now, although this category only carries 10% weight in your overall potential score, it also has the potential to influence that bankruptcy indicator score that we talked about at the very beginning. And if a potential lender sees a lot of new inquiries over a short period of time, it could be an indicator that an individual is going to file bankruptcy. Now, there are some nuances to this that I'm going to cover a little bit later in the presentation. So how do you get the perfect credit score? As I mentioned earlier, the perfect credit score is considered to be 850. However, it's really not necessary or practical to fret over getting an 850 credit score. Having an 850 might impress whoever's looking at your credit. It might impress your friends, but it won't get you a better interest rate or opportunity for credit than someone who has a score in the mid to high 700s. In fact, a 740 and higher at Truity will get you the same interest rate as someone who has that perfect 850 score. However, it can be a good idea, although you don't want to worry about getting the perfect score, it's a good idea to consciously make decisions that are going to boost and maximize that potential score. But there's no need to obsess over every point. You also want to avoid behaviors that are going to lower your score. After all, simply the act of applying for new credit or taking out a new loan can drop your score. Now, I'd like to talk about some things that you'll want to avoid while trying to maximize that potential credit score. The first and the most important on my list is payday loans. Payday loans are considered subprime lenders, not only by other creditors, but by the credit bureaus. They're also, many of them are considered predatory lenders and tend to target lower income and lower credit score households. And so you want to be very cautious in who you're dealing with taking out a new loan. If you find yourself in a position where you need to get quick cash for an emergency, it's really best to approach your financial institution where you have your savings account or checking account where you usually do business, because they have products that will meet the need that you have, and it will likely be at a much lower interest rate than payday loans. I've seen a lot of individuals get into payday loan trouble, and although they make the payments on time every month, it's very difficult to get out of that situation just because the interest rates are so high. Another thing you want to avoid is taking out too many trade lines in a short period of time. I've touched on this a little bit, but it's called escalating debt, and it can look to a creditor as though you're potentially going to be filing bankruptcy. Now, I want to break this out a little bit and talk about two different scenarios. Someone like myself, I'm in my late 40s. I've been utilizing credit for nearly 30 years. My credit history is very predictable, and if I were to go out and buy a new car or two, open up several new credit cards, maybe get several store cards all within a short period of time, that is outside of my normal activity and would definitely look to a creditor or the credit bureaus like I was setting myself up to file bankruptcy in the near future. That often happens when somebody knows that that this is going to happen. They're going to file bankruptcy. They'll open a lot of new store cards and get as much stuff as they can, knowing that it's going to be very difficult to obtain credit for a period of time while they're trying to recover from bankruptcy. On the other hand, if someone is maybe just out of school, just getting started in life, getting out on their own, and they get a new mortgage, a new auto loan, a couple of credit cards, and maybe a store card or two, that activity is normal for somebody at that point in life. And so that bankruptcy predictor score is not going to drop in that individual like it would for someone who has been utilizing credit for a very long time. You also want to avoid maxing out those revolving trade lines. Remember that 30% rule. It's best to keep your balances low on credit cards and line of credit, and ideally pay them off each month. It can save you an awful lot of money in paying interest, and it's going to help maximize your credit score. You'll also want to avoid co-signing for other people. Now, of course, there are exceptions to that rule. A spouse or spousal type situation, somebody that you're in a long-term relationship with, it's perfectly normal to co-sign on a mortgage or an automobile. But if you need to understand that even if you're considered the co-signer, if you put your name on that line, you sign your name to that agreement, that debt is equally yours. And if the other person for some reason decides not to pay, that full responsibility falls on you. Bankruptcy. This is kind of a given, but bankruptcy is considered the kiss of death to your credit score. It's not the end of the world, though, and you can recover from bankruptcy. You just have to take some very dedicated steps to recovering your credit score. And the last one is actually the first one that we talked about in payment history. You want to avoid letting your loan payments get past due. Everyone has emergencies in their life or has situations where life is difficult. And if you find yourself in that situation, it's much better to be proactive and approach your creditors and ask for help rather than just ignoring that payment and letting it go past due. The vast majority of creditors have options in place to help you through difficult situations that will not have that negative influence on your credit score. And then I'll finish up with some tips on how to start building credit, and these can also be utilized to restore credit if you've had some credit difficulties in life. The first is start small and start slow. I recommend not following the previous rules of not taking out a lot of credit at one time. Start with one trade line. Make sure that you can manage that well, and then as time goes on, add additional trade lines as you need them. One of the best tools to get a great credit score rather quickly is by using cash secured loans. At the credit union, we call them share secured loans. These loans typically have an interest rate of around 2%, and they do not require a credit pull because there is zero risk to the lender. With these loans, you use your own cash as collateral. The lender will put your cash into a savings account and place a hold on those funds for the amount of the loan. As you make your payments, that hold on the loan is released by the amount of principal that your payment pays down. And so if, let's say you have a $500 share secured loan and it's set up for a 6-month term, by the time you make your last payment, that $500 is free and clear. You can use it to take out another payday loan, another share secured loan, or you can use it as you would any other funds. This is a very easy short-term tool that will get your score to a point where your next loan will have a much lower interest rate than if you have low credit or no credit. The next is getting a small credit card or line of credit. And if you have trouble managing your funds, feel free to skip this step. However, it can be important to have at least one revolving trade line. Without a revolving trade line, your score will revert to 0 on the 6-month anniversary date of your final payment on the last close-ended loan that you've had. So if you have an auto loan and that's the only loan that you have on your credit, once you make that final payment on the 6-month anniversary date of that final payment, if you don't either take out new credit in the form of a close-ended loan or have a revolving trade line on your credit, your score will go to 0. If you do decide to get a credit card, go to your preferred local financial institution rather than using mail offers. Find an institution that ties their rate to the Fed rate. This will prevent massive spikes in interest once those introductory periods expire. The credit union uses a rate for credit cards that is tied to the Fed, and therefore, unlike some Visas or Discovers, the rate can't jump to 23% after that intro rate. If you plan to finance a vehicle at a dealership, it's a good idea to get pre-approved with your financial institution. When you're at the dealership, after you have a pre-approval, advise that dealership to only send your application to that preferred lender that you've been pre-approved with. This will prevent multiple credit pulls on your account, on your bureau, and will also prevent unwanted future solicitations from lenders that you might not want to do business with. Now, it's important to say that if you are applying for an auto loan, any credit pulls that you incur within a 14-day period that are auto loan related, such as dealerships, financial institutions, those are all going to count as one credit pull. And I'm not 100% sure, but I believe with mortgages, that is stretched out to 30 days. If you're applying for a mortgage, any credit pull that is mortgage related within 30 days only drops your credit score as if it were one credit pull. Next, do your homework and don't borrow on a whim. Shop around, find the best rate and term that best suits your needs. If you're just getting started out and don't have a very high credit score, you can't expect to have a 2% or a 3% rate on your auto loan. But you can shop around and find the institution that has the best rate. 25 years ago, it was very common for everyone to have one financial institution. They did all of their business at that one financial institution, and oftentimes it was done on a handshake and a single signature on a piece of paper. Now, there are so many financial institutions out there that are competing with each other with digital banking and online applications that financial institutions are much more competitive now. And if you have great credit, there's absolutely no reason why you shouldn't have the best available rate. Once you have achieved that great score, that 740 or above, it's okay to be a credit snob and to not settle for a rate that you deserve better than. Don't just rely on that one institution that you've always done business with, unless it's Truity Credit Union. Ask questions. Go to your financial institution and ask for the best options for the goal that you're trying to achieve. It's a good idea to check with somebody who has experience if you're inexperienced in borrowing, whether that be a parent or if you don't have somebody that you can reach out to, feel free to reach out to any of the member service representatives at Truity or your local bank, whoever you do business with. and I'm sure that they'll be happy to answer any questions that you have and help you find that best option for what you're trying to achieve. I really appreciate you watching, and I'll answer any questions that you might have.
Okay. What should I expect to find in my credit report?
I'm sorry?
What should I expect to find in my credit report?
Sure. The question is, what should I expect to find in my credit report? Well, credit reports have a number of things. They'll have your personal information, your address, your social security number, your previous address, date of birth, and that's why it's a good idea to keep an eye on your credit report. Make sure that your identity has not been stolen, because if somebody gets a hold of your credit report, they have all the information that they need to take out credit in your name. You'll find all of your previous trade lines that you've had and your payment count history back to 4 years, 48 months. You'll have, if you have collections, bankruptcy, slow pays or late pays on credit, those will be found in your credit report. Remember, your report is like a resume. It's going to show your work history where credit is concerned. The credit report also contains the information of the credit reporting bureau that it was pulled from. So if it's a TransUnion report, it's going to have the address, website, and phone number, contact information for that bureau. I recommend that each year everyone utilize the free credit report from each of the 3 major reporting agencies. You won't get a score with that free report, but you will get your credit history, and you can see if there's something on there that maybe shouldn't be and address that. If you do find something out of the ordinary, the first thing you should do is contact that creditor. If that creditor is not willing to resolve the issue, then you should contact the credit bureaus and send a demand letter to that creditor demanding that they repair anything that shouldn't be there. Another thing that you'll find, if you have put a credit freeze on your credit account, or if you have had previous fraud on your credit report, if someone has stolen your credit or identity, that will be reported on there, and each creditor has a responsibility to call the number that you provide to the credit bureau and make sure that it is you who's applying for credit and not someone else. Any other questions?
If someone has bad credit, what is the easiest and fastest way to fix that?
If someone has bad credit, what's the easiest and quickest way to repair those issues? By far, I would say it's that share secured or cash secured loan. Some financial institutions will offer a cash secured credit card, which works in the same manner as the cash secured or share secured loan, because you do not have to have a credit pull. Because it's secured by cash, it's going to be the lowest interest rate possible. As I mentioned before, it's usually right around that 2% rate, and those type of loans will usually increase your credit score very quickly. Now, on the other side of that, if you've already got great credit, there's no need to use cash secured loans. In fact, it can look to a creditor like you're trying to, well, I don't want to get off in a rabbit hole, but if you've already got great credit, there's no reason to utilize those cash secured loans. But if you have no credit or poor credit, they're great tools for boosting that score.
If we have it where 2 people get married, and one has good credit and one has bad credit, what's some advice with that?
Sure. If you're newlywed, or maybe you've been married for a long time and one person has great credit and the other person has very poor credit, joint applications are really a good idea, because as long as the person with great credit is taking care of it, and making sure that the payments are getting paid each month and everything's being taken care of as it should, then the person with poor credit is going to have the benefit of that new credit, and as it goes on, it will build their score. They'll also usually have the benefit of the other person's great credit score, and so the rate will be much lower than if they were applying individually. No other questions? Well, I hope it wasn't too short, and I enjoyed this time. And if you have any questions, as I mentioned before, just reach out to your local financial institution, and I'm sure they'll be glad to help you.
Thank you, David, for that wonderful, informative performance. Join us in March for our next Life Hacks program. Thank you.